Hi guys, how are you? Welcome back. Welcome to Real Macroeconomics. Welcome to Trading View. Welcome to YouTube, and welcome to my subscribers. How you guys doing? What a week, huh? Interesting times that we're living in. Is the market bearish now? No. No. That's it. You can log off now. Um, Look, in bare knuckle charting, there's a rule. So long as you are in structure, the bias remains to the upside. Okay? Now, having said that, we're at a key area. When the market opens up tomorrow night, U.S. time, it's going to be at a key area. We close at a key area. Now, what's a key area? It's a key area. It can go either way, but this is where you want to. If you're a bull, you want to buy here. If you're a bear, you want to short here. All right. Now we've had 6 of these areas in the past year or so, year and a half. Okay, there's 6 of them in total. And if you followed the bare knuckle charting, then if you were a bull, you were by the dipper, you ended up right. Doesn't mean that you'll always end up right. So this is a key area here when we open up on Monday. Now, personally, I'm short. Okay. Um, and just remember, guys, this is my diary. You guys get the key to peek in it. All right. I'm not going to show you or tell you everything. That's for my subscribers, but this is for me. I post things that I want to keep track of, to think about, to remind myself, to see what I am seeing over the course of time, and I just kind of go through it and see what am I what am I seeing? What is the data telling me? Not me telling the data. What is the data telling me? That's a very big difference. Okay. And all of these things are pieces of the puzzle, and we're going to go over them here in a moment. But it's great that TradingView now incorporates FRED, um, the Fed data system, and we can chart it. I can do so much more with it than I could before. All right. So, are we bearish yet? I would say no. Okay. Now, having said that, things are not looking good at all. At all. They're not looking good at all. So, let's go back in time and let's look at some of this stuff here. Okay. Let's look at what's going on. I've been doing a lot of the macro stuff lately because I think it's important to understand the macro stuff. First of all, nobody saw inflation coming. Okay. I mean, a few people did. Of course they did. But, MMT revives inflation, right? We can print to infinity. Don't worry about it. It's like saying, you can eat as much as you want up to the point where you gain weight. Well, I can't eat as much and whatever I want until I gain weight because I will gain weight. So taking a look at Chiba, okay? Cryptos, I've been pounding the table. Be careful, all right? If you go back in time, you're going to see back on December 1st that I said, this is a false breakout. Be careful, guys, right? What's happened since? Yeah, it was a false breakout, okay? Again, on this chart on December 28th, I said, look, there's a false breakout again. Boom, broke out again, broke down. All right, so Ethereum, let's go back in time. I said back on November 30th, look, I'm taking my money, I'm leaving. See you, bye. Have fun. Right here. I'm selling, taking all my profits here. It was at 45.75 at the time. You don't want to know what it is today. Okay, uh, it's crapped. Magic is what I call it. You know, again, I was warning here. This is December 28th. Look, it's breaking. It's breaking this bear flag. We have a bear flag and it's breaking. This is going to resolve to the downside. Right? Boom. That's what's happened. Right? Magic. Um, Fast forwarding now to Solana. 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 All right, Solana. Bulls don't want to see this break. It broke. All right. Now it's a little dot here. But if you really measure it in terms of percentages, it's a very big drop. This is a log chart. That's why it looks so small. But it's a very big drop. All right. So yeah, crypto after crypto after crypto. I've been saying this. Okay. Now, let's take a look at this. Right? What's wrong with this picture? Right? Public debt. Yeah, exactly. We had private debt as a problem, household debt. Well, first of all, let's go back in time. This goes back to 1957. And what you're going to see is that everything is pretty much uniformly, flowing. Some more, some less. Everything is fine. You got GDP on top, then you have personal income, disposable income, household debt, and then below that was public debt. Okay? That's a nice, perfect economy. Fast forward to 2000, everything starts to go to shit. And as you can see, all right, as you can see, private debt, household debt started to rise excessively, started to surpass the disposable income, then personal income, and then it almost surpassed GDP, right? And then we know what happened. The market tanked. Well, how did this happen? Well, guess what? You had public debt just explode to the upside, and it's just gone parabolic vertical. That's not going to end well either. You can't just keep doing this. You can't just keep printing for the people's economy. Eventually, there's going to be consequences. All right. And that's what I'm showing here. What's wrong with this picture? Be aware of it. All right. Put things in context. Think about what's going on. Um, here's something to be thinking about. Employment costs highest in 2 decades. Okay. Now, first of all, we have to understand what kind of problem we have. We have an insolvency problem. The government has been backstopping risk for such a long time uh, for the economy, for the zombie companies, for stocks mostly, right? Asset prices. Backstop the risk, backstop the risk, backstop. Okay, well, you backstop the risk, and then you ended up in a situation where you have inflation, right? So printing for the people's economy suddenly is no longer useful. So now what are you going to do? Now what are you going to do? Raise rates going into a slowing economy with a bunch of zombie companies? Now, what is a zombie company? Zombie company is a company that is not seeking to grow or maximize profit. It's just barely surviving. Now, let's look at these zombie companies, right? They got two major problems. They got a lot more than two major problems. But what ends up happening is that first of all, you have a unit labor cost rising. They cannot pass off that cost on to customers because they don't have the pricing power. That's why they're zombie companies to begin with. So that adds to their costs and squeezes their profit margin. Right, what if they have profit, which they usually don't? Okay, but gross profits, they start to squeeze it. All right, fair enough. Producer price index. Their costs are up 10% for raw materials since last year. 10%. That's a problem. Okay, big problem because they cannot pass off that to customers. So you got unit labor costs, raw materials up 10%. What else do you have? Well, if you are a zombie company, you are also uh, you have junk bonds. And as I show here, this is January 5th. And I said, look, this is bearish. Okay, this is a bear structure. And you have a 1, 2, 3 bear flag. You can see it clearly. It's breaking. You don't want this to break because lower bond prices means higher interest rates, right? What's happened since? Boom, right back down. Now remember, the Fed is buying junk bonds. Yeah, it's fun, right? Wait, it gets better. So now you have profits margins, gross profit margins being squeezed by unit labor costs, by junk bonds. You have to pay more to service that debt and produce a price index. You think that's not gonna start to blow up companies here soon? It's not. It's not looking pretty. I tell you that much. All right. Um, look at the labor force participation. Okay. Look at labor force participation. Now, this goes back to 1957, all the way back here. Okay. As when we had low deficits and low imports, labor force participation was rising all the way up to 2000. And there's a number of factors why that happened, right? Women came into the labor force, whatever, blah, blah, blah. Okay, fine. Um, but we did have low deficits, and we were not net importers like we are today. I didn't put the import line in here, but it pretty much looks like this. Okay. Fast forward since 2000 and look at labor force participation falling. Okay. It hasn't gone anywhere. The best you can say it's that it's flat. Now you can sit here and argue with me and say, well, it's the baby boomers retiring. It's a simple answer, but it's not true because millennials, and here's millennials, they are bigger than boomers. Can't give me that line. It's not because boomers are retiring. Okay, so you see, the more you print, the less labor force participation you have. The more free stuff that you want to give to people, the more inflation you're going to end up. Okay, it sounds good intuitively that, well, the government owes me. The government doesn't owe you anything. The government has nothing to give you. Okay, those who wish to live off the government need to remember that the government lives off of you. So the mathematics doesn't work. The government doesn't have anything to give you. So you see now that you see labor force participation falling. You have high deficits and high imports. We're going in the wrong direction, and we're printing up money like there's no tomorrow. And we have inflation, and you can't even print anymore. And you have unit labor costs rising, and you have, we've priced ourselves out of the market. You think our labor force can match with the rest of the world with the wages we're getting paid? You can't. Not because I'm saying it, because you can't. You cannot compete with a Vietnamese, a Taiwanese, a Chinese, Filipino. You can't do it. So we are headed in the wrong direction. Things are not looking all that good. All right. And that's basically what I'm trying to show you here. Why it's not me. I don't tell the data what to do. The data tells me what's going on. So you got junk bonds are falling. And think about it, right? When there's your revenue comes in, it can either go to consume or commercial or whatever, or you can pay interest. There's only a limited amount of dollars that zombie companies get. So if they're funneling more money to service the debt on interest, funneling more money to pay uh, workers, okay, funneling more money to pay for raw materials, okay, what happens? Things blow up. That's what happens. All right. So while media and everybody's telling you, oh, look, everything is great, 3.9% unemployment, the economy is super, it's strong, it's wonderful. No, it's not. All right. So, look at this one. Buy now and pay maybe later. Pay maybe later. All right. What's happened? Boom. Blew up. That was back on December 15th. And sometimes I have to put these things up again simply because people forget. You forget my calls. It's here. You're just kind of shifting through all the stuff there, seeing a whole bunch of charts, but you're not really getting the full picture when you're looking at my stuff, my work. Okay. So again, you're getting 1 penny, 296 billion. You're getting 1 penny of GDP growth for every new dollar that is created. 1 penny. By comparison, in 2008, 9, 10, whatever, for every new dollar that was created, you were getting about 36 cents of economic growth. Now you're getting less than a penny. I wonder why. But again, labor force participation. Millennials are bigger than boomers. They're buying stuff, right? Going on vacations, drinking, partying, girlfriends, wives, kids, baby carriages, furniture, right? We should be booming right now. We can't even get 1 penny of GDP growth for every new dollar that is created. Horrible, 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 horrible. All right, Apple. This one was so difficult, right? I called the double top here. This is textbook, blah, blah, blah. Okay, blew up in my face. Look at that. Okay, but what did I tell you last video? I said I'm not convinced. It's still bearish. I'm still holding on to my short. And guess what? Boom. There you go. Very, very, very difficult to be calling shorts in mammoth strong companies like Apple. You got to be a little bit crazy, right? But you got to have big webbles. Where was I? Okay, big webbles. Right. So again, cracked, back down again. By the way, this kind of clicked up. I wanted to show you this. We have a cash famine. We have a cash famine. Look at this. Yeah, it's in the U.S. net worth share held by 90 and top. Oh, it's wonderful. Look at this. It's great, right? This is crazy talk that we had a cash famine. But people run around believing this stuff. Don't listen to this stuff. Look at the evidence. Look at the facts, math, and data, guys. Don't listen to this stuff. Believe me. ARC, Bubblicious. Okay. Who remembers this back from last year? Look at that. I said, look, it's Bubblicious. It's done. Halas, finished. Bye. Right. Boom. 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 Yeah. Everybody loved ARC, a year ago. Everybody loved it. Not so much today. Risk off. These things are not very good. Tesla. Again, I said Tesla back November 23rd. This is classic textbook bare knuckle charting setup. Sure enough, nothing has changed. It's still bearish. Okay. CRM. Where's CRM? There it is. Strong company. Very good. To be making calls like this is you got to be a little bit loco la cabeza. Right? December 18th. Look, broke. Likely next move down. Boom. There it is. Okay. CRM was better than Apple. It was kinder to me. I could hold a lot easier. But nothing has changed. Okay? Nothing has changed. So that's about it for this video. Are we in a bear market? Not yet. We don't have the bearish signals, but it's not looking good. It's not looking good economically. It's not looking good fundamentally. It's not looking good in the charts. You can't have ARCs blowing up. A firms. I don't know if I showed that one. Right? Buy now, pay maybe later or something. Right? Look at that one. This was back on December 15th. This is going lower. Boom. There you go. Okay. Uh, and it's probably going to go even lower. I think it's going to break. I don't think it's going to hold. So, look at the 30-year mortgage. Okay. It's breaking out. This is the yield. So that means that bond prices are being sold off, which means yields are breaking out. Well, this is a major breakout possibly here. Okay. So what happens when interest rates rise? Well, home prices come down. Okay. Because people don't buy homes for the price anymore. They just buy the mortgage. And if they can afford the mortgage by lowering interest rates, they'll buy it, no matter what the price is. But you start seeing the reverse where interest rates are rising. Well, home prices are going to have to come down in order to meet that sweet spot for people to buy mortgages. So I always get kind of like inside me annoyed when I hear people, oh, I bought a home. Oh, really? You pay cash? Oh, no. I got a nice 30-year mortgage. Oh, so you bought the rights to own a home 30 years from now. Okay, got it. Thanks. Appreciate that. So you bought a liability is what you did. But nobody looks at it that way, unfortunately. Anyway, that's it for this video. Thank you very much. I hope, you guys learned something from this. Possibly, maybe. If you want to learn more, then, you have to keep following me. All right? Thank you very much. Happy, healthy New Year. Let's see where we can make some money, and I'll talk to you guys soon. Be careful out there. Caution, caution, caution in all asset classes. Caution, caution. Take care. Bye bye.